Today's episode is brought to you by Bit.com. You'll be hearing more about them later on in today's interview, which begins right now. I am joined by Jurrien Timmer, Director of Global Macro at Fidelity. Jurrien, welcome to Forward Guidance.
Nice to see you, Jack.
Great to have you here, Jurrien. I am a chart guy, and you have the best charts in the game. We will definitely get into them. I want to start by asking you, we're filming on Tuesday, April 12th, where this morning we learned that the U.S. inflation on a year-on-year basis reached a 40-year high of 8.5%. Jurrien, I've heard you say that if investors can get inflation right, they can see the whole picture and get the investment landscape right. What did you mean by that, and what's your outlook on inflation?
Sure. Just a quick word on the number today. And you see the markets, the stock market's up, crypto's up, gold is up, bond yields are down. And even though it was, still a horrific number, right, 8.5% year over year, but you get it reminds me actually of kind of earnings season, where like if the whisper number, is what gets hit, then you get a different response than if it just meets expectations. So the number was not as bad as people feared, and that's why the markets are rallying. So it's just a reminder that it's always that second derivative that drives markets. It's not the level. But to your question, inflation drives the 60-40 paradigm, right? So during periods when inflation is low but positive, so let's say 1 to 3%, the 40, the bond side, tends to be negatively correlated to the 60, which is the equity side, and that together makes up a 60-40 index. During periods where inflation is above average, which is 3%, so above 3%, the correlation historically has been positive. And so if you're an investor, and there are millions and millions of them out there that may not be directly benchmarked, but kind of conceptually benchmarked to some sort of 60-40 portfolio or index, getting the inflation part right is paramount, right? So in the old days when interest rates were high and real interest rates were positive, then even if the 40 didn't protect you against the 60, at least you got some income out of it, right? But in these days, although less so than it has been in recent weeks, if you're getting a low nominal yield and a negative real yield, the only reason to own bonds is to protect yourself against drawdowns in the equity markets. And so you need that negative correlation, right? So when stocks go down, you want bonds to go up in price or in return. And so, the inflation backdrop is vitally important, because if we are going to be in a sustained inflationary environment, and that's not necessarily a prediction, but it's certainly not an outlandish call these days to say that, and you're getting neither the nominal or real return nor the negative correlation, then we really have to think about what actually goes into a viable portfolio these days.
Right, and even a moderation of inflation from 8.5, let's say, down to 3.5, which would be 500 basis points of transitory, that would still be well above the 2% that is sort of baked into the cake for the Fed as well as a lot of investors. So is that your case? Is that your base case?
Yes, it is. I don't know of anyone who expects 8.5% to persist month after month after month, because the base effects do kick in. And of course, the Fed and most other investors, incorrectly assumed that the base effects would have kicked in many months ago. But those supply chain bottlenecks coming from the pandemic proved to be more persistent than expected. And then as those did start to wane, and we do see evidence of it, right? If you look at container shipping rates from Shanghai or Beijing or what have you to the U.S., those are all coming down. Although with the Shanghai lockdowns, maybe that will change. But then, of course, the Russia-Ukraine war happened, and a whole new set of supply chain bottlenecks have emerged on the natural resource front, as opposed to the finished good front. So the transitory thing, was kind of thrown out because it just the inflation pressures remained more persistent than expected. But at some point, the base effect does kick in, and my sense is, and that's shared by my colleagues who actually look at this stuff every day, is that inflation will normalize towards, like you said, 3.5, 3, 4. And if you look at the TIPS market, that's exactly what the TIPS market says, right? So the 5-year TIPS break even is 3.5%. The 10-year is lower; it's about 2.7 or so. So that gives you a sense of what the TIPS market is thinking, and I would say that's generally kind of in the right direction. But to your point, the Fed's target is 2 for the PCE, by the way. The CPI tends to be about a half point above the PCE. So that means 2.5 is the target on CPI. And of course, with average inflation targeting, the Fed can allow for an overshoot. So maybe push it to 3 for a couple of years to compensate for the many years where it was under 2. So if we get close to that, then I think the Fed is going to be, it's going to tolerate it. Let's put it that way.
And they definitely are not tolerating the current high levels of inflation. Jurrien, how much do you believe in economic cycles? And if you do, where do you think we are in the cycle now? And does this economic cycle, does it have different characteristics than previous cycles? Because I know you've talked about how this is a very hyper-compressed cycle.
Yes. So we have something that we call the CRIC cycle that we actually developed for the Chinese economy. And CRIC stands for Crisis Response Improvement Complacency. So historically, when you look at the cycle, it tends to be about 5 years. You get a recession, that's the down cycle, of course. Then you get the recovery, which is the early cycle. That's kind of the V-shaped bottom that you see. And by early cycle, the way I think about it is things are still bad. Maybe they're even still getting worse, economically speaking, but they're getting worse at a less bad rate of change than before, right? The market always cares about second derivatives, the rate of change. So it's when the rate of change, when the level is still down, but the rate of change gets less bad. That's early cycle. Then when the level gets better and the rate of change gets positive, that's mid-cycle. That tends to be the longest phase of the cycle. So for instance, when you look at after the financial crisis in '08, we had many years of mid-cycle expansion, and those can persist for a long time, for certainly more than the 5-year cycle. Then we get late cycle, which is when you see a slowdown in growth, not a recession, but a slowdown, and you see inflationary pressures, and you see the Fed withdrawing liquidity. We're seeing all of those things. I mean, growth is slowing a little bit, not a lot, but so I would say we're kind of between mid and late, maybe closer to late cycle than mid cycle. But I think, the cycle, because the Fed is now such a powerful part of this crisis response dynamic, and of course during the pandemic we also had the fiscal side as well, that the U.S. cycle is starting to look more like the Chinese cycle, whereas instead of a 5-year cycle, it's more like a 2-year cycle, because you get that really heavy-handed response, monetary and fiscal, and then it creates outsized and faster, conditioning by the markets, but then it runs out faster as well. So I do think we're in an environment where the cycles are more compressed, not in terms of magnitude, but in terms of duration, and more dependent on the policy response. And so the Fed went pretty hard in one direction, 2 years ago, and until last month, it was still going hard in that direction if you look at the balance sheet expansion. And now it has to make up for that, for what many people would think is a policy error by the Fed staying too loose too long. And now it has to compensate for that by swinging really hard in the other direction. And so that's what I mean by kind of these compressed, exaggerated cycles, if you will.
And so what does an asset allocation look like in a mid to late cycle? It's my understanding that in your quote, typical, you're going into late cycle, you might want to load up on bonds, maybe be a little bit underweight on equities. But it's my sense, Jurrien, that there's a specific flavor to this economic cycle where the Fed is tightening so rapidly and the supply chain disruptions are so vast that I know that some of the things that you're interested in terms of asset allocation are a little bit different than that sort of overweight bonds, right?
Yeah, I mean, typically in late cycle, you get the inflation pressures, you have the Fed tightening, and I'm kind of describing the cycle of yesteryear because we haven't had a typical cycle in a number of years now. But typically what would happen is that combination, and growth is at that point also starting to slow. So earnings growth starts to come down, but it's still positive. So in that environment, equities is still a good place to be, but it's not as good as it was during mid-cycle, because you think about it, mid-cycle, the Fed doesn't yet have to tighten policy. So the interest rate and liquidity environment remains very favorable. Earnings growth tends to still be growing, accelerating. And so that's like the perfect backdrop for equities, right? And that's kind of what we had last year, right? Earnings growth was 50%. Bond yields were super low. The 10-year was like at 1%. The Fed was doing QE. So you had a perfect storm of tailwinds last year. And now we're getting the opposite of that. But historically, when the Fed's tightening, and when you get that yield curve inversion, that of course very briefly happened a few weeks ago, and then it uninverted, and maybe it'll reinvert, in the future. But typically that inversion happens because rates are rising across the yield curve, but short rates are just rising faster than long rates because the Fed drives short rates. And usually when the Fed's tightening, it's tightening a lot very quickly. And that's what it's doing today. Well, not quite yet today, but the market is doing it for it. So today's cycle actually is reminiscent of the older cycles, not the cycles we've seen more recently, like the 2016-17 cycle, which was very graduate, a quarter point every few months. That's not what this is. This is more like a typical traditional cycle from years ago. So typically, that's not actually a good time to own bonds because yields are rising. But once you reach that peak, then of course it's a great time to own bonds and more defensive equities. But at that point, you're transitioning from late cycle to down cycle, and we're just starting to kind of enter late cycle now. So I think it's still a little bit early for that. Although the bond market has moved so fast that at 2.8% on the 10-year, even though that's still a negative real rate, it's a lot less negative than it was. So certainly for any chart reader or any active asset allocating portfolio manager, high twos on the 10s, certainly starts to look attractive, I think.
You've seen a huge rise in short-term yields and just a tightening of monetary conditions. What is when people say tightening monetary conditions, what does that mean? And in what is the transmission mechanism? Is it coming from the Fed, or is it just sort of coming from the market because we're just at that point in the cycle where things are slowing down?
Yeah, so the Fed is trying to slay the inflation dragon, let's say, or it's like a fever. It's trying to break the fever, and to do that, you need to, if the fever is high enough, which of course it is right now, 8.5 is very, very high. The Fed needs to kind of shock the system, right? And it's doing that by trying to tighten financial conditions, and I'll explain that in a second. But if you think about it, right, a lot of the price inflation that we're seeing comes from supply restrictions, right? Whether they were supply chain bottlenecks or now sanctions and natural gas, wheat, corn coming out of the Ukraine. But there's not much the Fed can do about that, or anything for that matter. But there's also a demand side. Of course, the U.S. economy is ripping, and people have jobs, they have savings, they have income, they have money to spend, and they're spending it. I was on the road last week. I was in Austin for a couple of days. There's not an empty seat on any plane, and there are barely any empty hotel rooms for that matter. So the demand is there, and the demand is kind of what the Fed can try to address, basically. And so that's what it's doing. So financial conditions, I look at the Goldman Sachs Financial Conditions Index, but there's several different ones. There's a Bloomberg one as well. But the Goldman Sachs one, it's based on 5 indicators. Short rates, long rates, credit spreads, the dollar, and the S&P 500. And the S&P 500 is by far the biggest driver. And so the Fed, the dollar's going up, that tightens financial conditions. It makes liquidity less ample, and that's basically what financial conditions, show. In other words, the Fed looks at the real economy, but the data that it looks at, like everyone else, tend to be lagging, right? I mean, the Fed has a dual mandate of full employment and 2% inflation. Those reports are both lagging indicators, so the Fed, cannot really set forward-looking policy based on backward-looking indicators. And that's why the Fed looks also at the financial economy as to get a more real-time feel of where things are. And the financial economy, kind of the best indicator for that are financial conditions. So that's why the Fed looks at financial conditions to give it more of a real-time anchor of where things are. So that's the importance of financial conditions. And the stock market, of course, is a big component of that. It drives a wealth effect in both directions. Of course, the direction of interest rates drives the cost of capital. Credit spreads drive the same thing. So the lower credit spreads go, the lower interest rates go, the lower the dollar goes, the higher the stock market goes. Then financial conditions ease because basically liquidity becomes more ample. So the Fed is trying to reverse that. You can see in this chart here that last year the financial conditions index actually reached its most accommodative, maybe not ever, but in a very, very long time. And so the Fed is trying to reverse that to dampen demand, to slow the economy, not break the economy, but slow it. And that's always a very, very delicate balance, of course. And all of the components of the financial conditions index were moving in the Fed's direction. So rates, spreads a little bit, the dollar, with the exception of the stock market. And that's why, Dudley last week was out there saying, if the stock market doesn't go down, we'll make it go down. Not exact words, of course, but because that's a very big component of the FCI, and it needs that to start behaving, if you will, in order to reverse the wealth effect just enough to kind of break that inflation fever. And that's threading the needle if there ever was one.
I didn't know how large a component of the financial conditions index the stock market was. That's very interesting because arguably it's the least connected to the real economy. So we're looking at this chart, and on the bottom is the forward rates curve. So I think the Fed has been very successful so far in telecasting what it wants rates to be, and the market has complied, pricing in what the Fed's future path of policy is going to be. Credit spreads, they've widened a little bit, but not a ton. But it's been that stock market that's been defiant in the face of this monetary conditions. Jurrien, why do you think the stock market has been so resilient in spite of the tightening of monetary conditions that we're seeing from the Fed?
I think there's a couple of explanations, but one is I think that the stock market is kind of taking the glass half full approach, and you can see in that forward curve in that chart, and there's another chart that shows the blue line that's good as well, that there's a kink in that curve, right? So the Fed is trying to shock the system by going beyond neutral. Neutral is considered to be around 2.5%. And that's kind of based on where the neutral rate is and where the expected inflation rate is. And the Fed is trying to shock the system by going beyond neutral, right? And the latest forward curve showed about a 3.5% extreme. But then that line goes back down to about 2.5. So I think the stock market is maybe following the 1994 playbook, which is a long time ago, but that was the Alan Greenspan Fed's tightening cycle. Which came out of the blue because back then the Fed was not transparent at all. It was actually the opposite of transparency. Greenspan famously said that if you think you understood what I just said, then I didn't express myself very clearly, or something to that effect. So that was kind of a shock and awe Fed cycle. It was a preemptive strike against inflation. And it was a successful one. It was one of the few times in history that the Fed actually engineered a soft landing. Inflation never materialized. The Fed, after 300 basis points, was able to step off the brakes, ease by 75 basis points. And then, during that year in 1994, the stock market went sideways. It had a couple of 9 to 10% drawdowns, and a very sharp valuation derating of 9 PE points. And then in 95, it just absolutely took off. It was up 35%. So on the surface, it kind of feels like a repeat of that, right? The market has been in a range. It drew down 15% at the lows, which was the day after Russia invaded the Ukraine in late February, and it's been bouncing around. And most of the derating, most of the drawdown in the S&P has been on the PE side. The PE fell 7 points. It's now up again. And I think the market is just kind of hoping for a repeat. But this is a different cycle, of course, because back then the Fed committed a preemptive strike against inflation. This is hardly a preemptive strike, right? This is a very reactive strike, and that suggests that the Fed has to go farther than it did back then. But then it's also going to come back down quicker, presumably. And so maybe that's what the market is focused on. Also, the earnings backdrop, at least on the surface, is constructive. Earnings are expected to grow 10% this year, although X-energy, which is only 4 percentage points of the S&P, that number goes down to about 6 or 7, but still respectable. That's about the long-term average. And so so part of that PE derating that I think is underway and probably will continue to happen, if that's offset by earnings growth, then that leaves less of a need for price to come down. So I think that's kind of the glass half full approach that the stock market is taking. The risk, of course, is that if the Fed really has to go farther than people think, so not to 3.5, but to 4.5 or something, the risk is that the Fed will break something, right? That it will sacrifice the economic expansion in order to tame the inflation beast, and then you run the risk that the earnings picture starts to fall apart, and then you have a PE derating without an earnings offset. So that's kind of how I think about it. But again, today's number shows that even if the inflation numbers are really bad, as long as they're not worse than expected, maybe that gives the market a little hope, and that's why the S&P is up. It's only up about 60 basis points.
So we've got those three components for stocks. There's what they're actually going to earn, the future stream of cash flows, and then how those are valued back to the present, which is the discount rate. And then that's a component itself of the risk-free rate, which let's say is the Treasury yield, which is affected by inflation, what we're talking about, as well as that equity risk premia. I know you and your team at Fidelity have done a lot of work on the equity risk premia. First of all, what is equity risk premia? And then what are we seeing there? Is it tightening? Is it widening? What's going on?
So I'm a big fan of the discounted cash flow model, which is a way to value not only the stock market, but individual companies, real estate businesses. I mean, basically anyone who is looking to invest in a business or a piece of land or whatever does a discounted cash flow analysis, right? And the model is very complex because there are so many variables, but in its basic format, you put expected cash flows or cash flow growth or earnings growth in the numerator, and then you put in a cost of capital in the denominator. And what you're doing is you're calculating the present value of future cash flows. I mean, that's the discounted cash flow model. So if earnings growth is expected at 8, 9, 10% for the next few years, which is what's currently the consensus, then that goes in your numerator. Then in the denominator is the cost of capital, or the discount rate as we call it. And that is the sum of the 10-year Treasury, which is considered the risk-free rate. I'm sure some people will argue with that, but that's the input. And then the risk premium, the equity risk premium. And the risk premium is like a credit spread. It's just the premium that investors want to get paid to hold a risky asset over a safe asset. And again, with the 10-year going to 2.8%, people will argue whether the 10-year is a safe asset, but that's a conversation for another time. And the risk premium is a little tricky because what most people think about is they take the PE ratio, they invert it to an earnings yield, so it's the opposite of a PE, and then they strip out the 10-year Treasury, and that leaves a spread, which currently is only about 2%, 200 basis points. And that's kind of a quick and dirty approximation of the ERP, the implied equity risk premium. There's an implied equity risk premium, there's a realized equity risk premium. The realized one is what historically investors actually would have earned in the S&P versus the Barclays government bond index, for instance. The realized ERP is around 4%, 4.5 or so, even 4.8. It just depends on how far back you go. This one here, the gray line goes back 100 years. It's 4.8%. So that is what investors would have gotten compensated with to invest in a risky asset versus a safe asset. But then you have the implied risk premium, which is kind of solving for if the S&P 500 today is correctly priced, what is the implied cost of capital in order to make those numbers all add up. Then you subtract out the 10-year and you get the implied equity risk premium. And so the blue line is using the DCF model. The orange line in the chart is just that quick and dirty earnings yield model. Either way, the equity risk premium has come down quite a bit, almost in lockstep, compensating for the rise in the risk-free rate. And so that's kind of the conundrum right now, not only for investors like ourselves, but also for the Fed, that when you add up the discount, when you add up the risk-free rate and the equity risk premium, you get the cost of capital. That has not really budged very much in the last few months. It's still around 5%. It was 5% before, maybe a little bit lower. So as the cost of capital for everything else has gone up, mortgage rates, corporate rates, Treasury yields, they're up, over 200 basis points. The cost of capital for the S&P 500, as implied by the DCF model, is only up about 40 basis points. And that is the disconnect that the Fed is trying to address, because it should be higher than that. The cost of capital should be maybe at 6%. And the difference between 5 and 6% may sound trivial, but you plug that into a DCF model, that's worth 5-6 PE points. That's a big, that's like 20% right there. And that's, I think, what maybe the Fed is trying to, I don't know if they think about it quite in these terms, but the Fed wants the stock market to behave the way other assets are by repricing the cost of capital and therefore lowering the PE ratio. And again, that doesn't necessarily mean prices have to come down a lot. I don't want to sound overly bearish, because the earnings part is the other piece of that puzzle. And if earnings are rising, it will go a long way to offsetting a decline in the PE ratio, just like what happened in 1994, where you had a strong earnings growth providing a buffer against a 9 PE point decline.
That's a really key point, that the tightening in monetary conditions is due to the risk-free part. If a technology stock went from here to here, it's not because the risk premia went up. In fact, it went down. It is the fact that the 10-year Treasury is now at 2.7 instead of 1.7. I see this a lot in the credit markets when people say, look at HYG, it's down 15%. That's the ETF for high yield bonds. But the vast majority of that is actually due to the rise in the risk-free rates, not the widening of credit spreads. And you can tell that by comparing that to the interest rate hedged HYG.
Yeah, exactly.
You said that they're at 5% now, equity risk premium. Perhaps they should be at 6%.
The cost of capital, not the risk premium.
Yeah, the cost of capital is at 5%. Perhaps it should be at 6%. What makes you say that? And then how does that compare to, let's say, a year ago when bond yields were much lower, and arguably, the earnings yield to protect the future returns for stocks were higher?
Yeah, so like I said earlier, the cost of capital has gone up for everything, right? So corporate bonds, Treasury bonds, mortgage rates, right? I mean, the average mortgage rate's now 5%. And so it makes sense that if it goes up for a company borrowing in the credit markets, why wouldn't it also go up for the equity markets? So to me, that's just a kind of a logical way of looking at it. And so if the risk premium, you can see that blue line on the chart, right? It mean reverts. It deviates from a central trend, but it doesn't deviate for that long, right? I mean, that blue line has an average of about 3.5%, and sometimes it's at 5, sometimes it's at 2. Right now, it's pretty low, and it generally doesn't stay low for long. So I do think the risk premium will revert back to some kind of average, whether it's 3 or 4%. And then it's just a question of what Treasury yields do in the interim, right? If the Treasury yield, the 10-year went to 2.8, today it's 2.68. If it goes back down to, let's say, 2.25, not a prediction, but let's just say, and the risk premium goes from 0.8 to back to 3, the discount rate kind of will stay relatively steady. But to me, it just makes sense that when the Fed is tightening and it's withdrawing liquidity from the system, the risk premium doesn't necessarily have to change. And like you mentioned, for corporate bonds, whether it's high yield or investment grade, credit spreads are pretty stable. So it's really the risk-free rate that is driving the bus, as it should, because that's that's what the Fed kind of controls, maybe not at the long end of the curve, but certainly at the short end. So it would be totally normal to see the cost of capital in the DCF model go from 5 to 6, and that's worth about 5-6 points on the PE side. And when we compare the 2-year yield, which is kind of what my favorite indicator is during Fed tightening cycles, the PE ratio will follow almost in lockstep with the 2-year on a reverse basis, right? So 2-year goes up, PE goes down. And on the basis of where the 2-year is, 2.5%, the PE ratio for the S&P 500 should be around 15, 16, and it is at 19 right now. So that's about 4 points of further downside risk. And so that the math all kind of adds up, and that 4 points would be reflected by an increase in the discount rate.
Today's episode is brought to you by Bit.com, an industry-leading full cryptocurrency service platform offering trading and liquidity provision services. Bit.com has it all. They support the spot market, perpetuals, futures, fixed income, and options products. It doesn't matter if you're a seasoned investor or you're new to the game, you need to be on Bit.com. They're the second largest in the Bitcoin and Ethereum options market, and they specialize in the efficient use of capital. Bit.com has launched a zero-taker fee options campaign until May 10th. To enroll, email VIP at bit.com. That's bit, spelled bit.com. And tell them I sent you. Okay, so there's equities, there's bonds, and then there's commodities, which have been an absolute all-star over the past 2 years. I know you've been very constructive on commodities. How much of your bull case on commodities is cyclical? In other words, last year we had a huge reflationary impulse that may no longer be with us. And how much of it is secular, which if it is secular, that means the commodity bull market is here for a longer time.
Yeah, I think we're in a secular bull market. But having said that, the commodity markets being the commodity markets, you get these massive boom bust cycles within secular trends. So obviously what we've seen in the price of oil, nickel, wheat, in recent weeks, those type of cycles don't last forever. I've gone back to 1784, and I show every kind of major spike in the individual commodities. Could be sugar one time, could be gold another time, could be oil another time. And then at the top, I show, I use the CRB. We can use the BCOM as well or other indices, but the CRB has the longest history, so I tend to use it. So, it looks to me like we're in a secular bull market, but maybe the cyclical boom within that secular bull is reaching its peak here, because, like I said, if you're fortunate enough to be long commodities during an upcycle, great, but don't overstay your welcome because they tend to give back what they gained relatively quickly. But then, if I'm right and this is a secular bull market, then that kind of boom bust will be followed by other ones off of higher lows, and that strings together a secular bull market. But commodities is a tough game. If you look at the efficient frontier over time, so volatility on the horizontal, return on the vertical, and you line up equities versus bonds versus other. Commodities don't really do well because almost by definition over the long term, they earn you the inflation, right? Because inflation is in part derived from raw materials. So you're getting maybe 3%, but the volatility that you pay for it, so the price you pay through volatility is, in the 20s. So it's very, very high. So you're paying a lot of, it has a high price if you measure price as volatility and a relatively low return. For instance, as compared to, for instance, equities, where you have a vol of 15 and a return of 11. That's far more favorable. And of course, equities compound returns, which commodities don't do. So it's not a great strategic anchor in a portfolio, but there are regimes where commodities work, and this obviously is one of them, and I think it will be a lasting one. The commodity markets tend to follow a long wave. It used to be called the Quantitative wave. It doesn't quite follow that as well anymore, but these long waves spanning several decades, and we seem to be in one of those. But, I did some back of the envelope work on looking at a 60-40 index or model, 60% S&P, 40% Barclays Ag, and that's shown on the chart. And you can see it's right on that kind of efficient frontier curve where you're getting about a 9% return for 9 vol, which is pretty attractive. It's not as good as the S&P, of course, but you have less risk, and it's certainly better than long-term government bonds, which have a vol of about 9 or 10, but a return of about 5 or 6. But if you start tinkering with both the 60 and the 40, which I did here in that inflation 60-40, and again, that's not a portfolio, it's not investment advice, it's just this kind of back of the envelope index that I created. And what I did here is I created a barbell on the 60 side of large cap growth and small cap value, because value stocks, especially small cap value, historically have been very effective inflation hedge. Large growth, not so much, but large growth has been such a dominant leader over the past 10 plus years that I don't want to be short large cap growth, because their ability to generate free cash flow is pretty undisputed. So I put in a barbell on the 60, and then on the 40 side, I threw out the ag. I put in some long bonds, some cash, some tips, some high yield bonds, some commodities, and since 2015, even a little bit of Bitcoin and gold. And I see Bitcoin and gold as 2 players on the same team. And you can see from this chart that the return over the past 70 years has been about 3 points higher than a traditional 60-40 index. The volatility is a little higher, but it's not as much higher as maybe certainly I thought or other people might think. So to me, that's kind of a more all-weather way of looking at it. And if the inflation regime remains elevated structurally, and that correlation starts to flip from negative to positive, then this is kind of one way of looking at asset allocation in that kind of new paradigm.
Mm-hmm. Jurrien, tell me about gold. What's your framework for valuing gold? Why do you view it as an inflation hedge? I know some people have been disappointed by gold as an inflation hedge. Maybe that's just more of a timing thing. And what's your outlook on it now? I saw based on a chart that there was at least one model you entertained that had a pretty bullish on gold.
Yes. So gold, I've looked at gold every which way that I can, looking at it during the 70s and since then. And to me, gold is a proven hedge against inflation, both on the price inflation side as well as the monetary inflation side, and actually maybe even more monetary, but both. And the best indicator for gold are real rates, which kind of makes sense, right? So if it's an inflation hedge and you're in an environment where real rates are negative, either because the Fed is financially repressing the system like it did in the 1940s, or for other reasons, then it's understandable that investors will want to invest in inflation-proof assets that at least generate a positive real return. And of course, bonds are currently not generating a positive real return. And the rule of thumb is that if you're buying bonds and you're holding them to maturity, whatever the yield is that you're getting when you buy the bond or the bond portfolio, that's essentially the return you're going to earn per year over the life of the bonds. And so if you're buying bonds at, let's say 2%, and the real yield is -1, you're essentially locking in a -1% real return over the 10 years or 30 years or whatever that the bond portfolio lasts. And so then you need to look at, okay, how do I at least get a positive real return? And of course, equities is one area. I mean, you got that compounding magic. That's, the eighth wonder of the world. And historically, equities have provided a solid real return. The problem is, like in the 70s, you get massive PE derating during very strong inflationary cycles, and earnings are not always strong enough to offset that. But that's a fairly rare outcome. But then you look at commodities, of course, which almost by definition offer inflation protection because they are part of the inflation problem, if you will. And then gold is there as well. And so, but what's interesting with gold is that when I go back, 50, 60, 70, 100 years, or at least since 1970, because before 1970, gold was just money. It wasn't it wasn't an investable asset class because it was based on the gold standard, the Bretton Woods system. So only since 1970 has gold been a viable asset class that people can allocate to. So that's about 50 years of history. And when you look at real rates, that has been a consistent driver. Like price inflation comes and goes, monetary inflation kind of comes and goes, but real rates is a consistent driver. And of course, since the TIPS market was developed around 2000 or early 2000s, the TIPS model, which is just the TIPS real yield, has been a very, very kind of tried and true indicator where if the TIPS real yield goes down, gold goes up and vice versa. But what's really interesting right now, if you look at this chart, you look at the blue line and the orange line. So the blue bars and the orange bars in the bottom panel is the real yield on a reverse scale, and the blue bars shows the TIPS real yield. And the TIPS real yield has been negative for a number of years now, but it's now becoming rapidly less negative. And on the 30-year horizon, it's already positive. On the 10-year, it's near zero. 5-year, it's still fairly negative. But based on the less negative TIPS real yield, that's a mouthful, gold really should be like at 1,600 right now, and instead it's at 1,970. So something is going on, and we've learned as chart readers for a long time that if a market doesn't do something that it should, or it does do something that it shouldn't, there's often a signal in there, and there's often a trend change in there. And the gold market is holding in much better than it really should have based on the TIPS model. And what I think is happening is, that orange line is that same model, but instead of using the TIPS real yield, I'm using the core PCE, which is the Fed's target. And of course, the core PCE is much higher than the TIPS break even, and therefore the real yield is much more negative on that basis. And on that basis, gold should be at around 2,800 right now. And so I wonder if there's a regime shift going on that the gold market kind of sniffs out, and maybe the equity market does as well, that if the Fed overshoots during this cycle and tightens more than the economy can handle, and yields rise more than the financial system can handle, because remember, the U.S. owes a lot of money, like many other countries. Debt to GDP, what is it, 140% now? The system can't really tolerate, 3, 4, 5, 6% bond yields. And again, that's not a prediction, but we're close to 3 right now. So maybe the gold market is sensing that if the Fed is going to break something, yields are going to go too high, and then it's going to need to resume quantitative easing for as far as the eye can see in order to repress yields back down. And that's what the Fed did in the 1940s during World War II and all the inflation that happened then. It's what the Bank of Japan, of course, has been doing for years. It's what the ECB just a few weeks ago was hinting at maybe doing if yields got out of hand. And so if the gold market, and by extension the equity markets, even Bitcoin, gets the sense that real yields are going to be negative for a long time to come, even if they don't get more and more negative, if they're just negative at all, then strategically investors will want to allocate out of bonds into real assets. And of course, gold would be kind of the number one real asset in this regard. So it's just a theory. I don't know if it's true, but that's kind of what I'm sensing in terms of how to explain this very resilient bid in the gold market when it really shouldn't be there right now.
Yeah, it's almost like the gold market is indicating like it doesn't really believe that the TIPS real yield, which is it's the nominal 10-year yield minus the inflation break even, what the market is pricing in for 10 years inflation hence. And then in the orange line, that is the 10-year nominal minus last year's inflation. So it's a different duration rather than having it be exactly matched. But maybe the gold is indicating that the forward inflation curve should be less downward sloping than it is, or the real forward, the nominal forward rates, as you said, will be lower than they are. How close do you think we are to there? Because now, I don't know what the 30-year is at, 2.8. At the beginning of the year, no one, even, no one would have forecasted that real yields would be this high. How much more damage do you think the financial system can take in terms of the long bond, the 10-year or the 30-year, before the Federal Reserve takes another look at things and say, actually, you know what, this whole quantitative tightening thing, it's a nice theory, but we're not going to go through with it?
Yeah, I think we are, getting to that point, but we may not be there quite yet because the economy is still very resilient. Consumers, they're employed and they've got money to spend, right? That's a pretty good combination. Even if incomes are not quite keeping pace with inflation, there is still that residual, those residual gains from the fiscal stimulus. And you look at the jobs market. There's, I think, twice as many job openings as there are people looking for jobs. So that's a pretty solid dynamic. But then you look at the mortgage market, right? 5% versus, and one indicator we look at is the average mortgage rate now versus the kind of the accumulated average rate for all mortgages ever generated, and the spread is pretty wide right now in terms of the current versus the average, and that gives you a sense of how much more potential spending power there is, because no one's going to be able to refi at these rates, right? So it's an out of the money call at this point. But you look at historically where the Fed has gone, and we had that chart up earlier with that new R-star chart, and where the Fed has gone against it, going back 40 years or so, the typical cycle is the Fed, when it eases, it goes about 200-300 basis points below R star. So R star is the neutral rate. It's not an actual a market rate, but it's a theoretical construct that the Fed looks at a lot. When the Fed eases, it goes 200-300 below. And then when it tightens, it goes 200-300 above. And so you can see, like a pendulum, the Fed goes, below, above, usually to the tune of about 200-300 basis points. The only time that did not happen was in 2018, when, we'll all remember that cycle. So the Fed, first the Yellen Fed in 15, and then the Powell Fed after that, we're gradually raising rates in, quarter point increments, no hurry, no pressure. But then in 2018, the Fed decided, to try to push beyond neutral and to go to 2.25, 2.5, maybe even higher. And then the stock market, basically had a protest. The S&P fell 20% fairly quickly in the last quarter of 2018, and the Fed had to back off. We call that the Powell pivot. And in 2019, the Fed was easing rates. The reason it was able to do that is because inflation was not a clear and present danger at any time during that cycle. So the Fed could, logically conclude that, okay, dual mandate, full employment, low inflation. If we've been underperforming against the inflation target for 10 plus years, there's little risk to kind of over listening to the markets, right? By following financial conditions, by looking at the stock market. And so it kind of stepped off the brakes and actually ended up easing. But in a traditional cycle, which is driven by inflation, that's why the Fed tightens policy when it does, it goes much further than that. And so the risk is, to your point, that even at 3.5%, which is currently what the market expects the Fed to go to by over the next year or so, that even that might not be enough if inflation does not start to come down. And on this chart, the purple dotted line is where the Fed will go based on the forward curve. That's the market expecting the Fed to do, to follow this path, and the forward tips curve. So you can create a forward curve of the tips yield curve and get a sense of what the market is pricing in for future inflation. So based on that, the Fed will still only go to neutral, even though inflation is now at 8.5%. And I think a cynic might say, if inflation is this much of a problem and it stays a problem, the Fed will have to go beyond that, not to 8.5% on the Fed funds rate, but at least it will have to drive real rates to significantly positive levels in order to slay the beast. But of course, as we talked about earlier in the conversation, no one really expects the CPI to be at 8.5% a year from now, right? So if it goes back to 4%, which is what the dotted blue line shows, then the Fed will actually be still accommodative at the end of this cycle. So I think the market is maybe correctly seeing that at this point, the Fed is not going to kill the system, because based on the current curve, the Fed is not expected to go so tight that it's going to break the economy. And maybe, again, to your earlier question, maybe that's why the stock market is holding in as well also.
Right. So even if you have a 3.2, 3.5% terminal rate in like the end of 2023, you're saying inflation will be at a sufficient level that will still be neutral or even loose monetary conditions.
It would be at worst neutral based on the TIPS forward curve. So again, I'm not looking at necessarily the 5-year TIPS break even or the 5-year forward. I'm looking at a synthetic curve derived from the forward structure of the TIPS market. And what the TIPS market is saying basically, inflation is obviously a problem. The 5-year TIPS break even is close to 4, but the 10-year is closer to 2.5, and the 30-year is even lower. So, even the TIPS market expects it to be transitory, but the question is, how transitory and to what level? And does the Fed need to maintain more of a persistence of above neutral rates, right? So the stock market and the forward curve is saying we go to 3.5, and then we're very quickly going to go back to 2.5, and 2.5 is neutral, is considered neutral. So as long as we end up at neutral relatively quickly, all is well, the economy will be intact, earnings growth will be fine. But the risk is not only that the Fed has to go further above neutral, but stay there longer. And that's why I'm looking every day at the shape of this forward curve, not only as to where it goes, but how quickly it kinks back down. And that's very much a moving target.
That is fascinating, Jurrien, because looking at this chart, you can see in 2018, the Powell pivot, it only touched neutral for like a month or two. You're saying it could stay there longer. What are historical analogs suggest about what that means for risk assets in general, when you have monetary policy hovering at neutral and not going back down to accommodative?
I think neutral is the equilibrium level, right? So you would expect the Fed, if the inflation threat disappears or at least recedes without the economy breaking, then the Fed can stop pushing this beyond neutral to the upside, right? But that also would not create any need to go back below neutral. So I think at that point, the Fed would target neutral, which currently is expected to be 2.5%. So if you look at R star, which is that smooth blue line, that's around 0.5%. These are all real rates, by the way. You add 2% inflation, which is the Fed's long-term target, you get to 2.5% neutral. So I think we're going to. So if the Fed can engineer a soft landing, it will go to neutral and it'll stay there. Or maybe it goes beyond neutral, goes back to neutral, and then stays there. Only in the next recession, whenever that might happen, would the Fed then go back below neutral. But what might happen is the Fed might end up at neutral, but decide that interest rates are too high and that they're cramping the economy's ability to function well. And again, the U.S. economy is highly levered to low interest rates. It's a very financialized system. Debt to GDP is very high, at least on the government level, not so much on the consumer level. So I think the interesting question at that point is maybe it keeps rates at neutral, but maybe it does less quantitative tightening than it says it's going to do. And again, that brings me back to what does gold know that we don't know? But that's kind of my way of of thinking about it. But to your point, you look at this chart. The Fed rarely ever is at neutral and stays there. It's usually going beyond it in one direction or in the other. But again, the second half of the 1990s, you can see that it kind of hugged neutral there for a while. And that's the soft landing that Alan Greenspan was able to achieve, right? So he brought it slightly above neutral. And then it kind of stayed there. And then it was in the late 90s, leading up to the dot-com bubble, that the Fed had to tighten again. And then it went well above neutral. And then, of course, we had the dot-com bust. But again, maybe a parallel is that 94, 95, 6, 7 period where the whole system was in a fair amount of equilibrium. And of course, that was well before quantitative easing, right? That was something introduced with the financial crisis, although the Fed did also do it during the 1940s, but it didn't do it from the 40s all the way to the financial crisis.
Jurrien, I want to ask you about the dollar. The dollar strengthening against other currencies is a risk-off signal. Typically, we saw the DXY go, in the 100s during March and April of 2020, but it's at 100 now. And you've got this great chart charting the relationship between the DXY, the US dollar index, and financial conditions. And for the past year or so, it fit like a glove, but there's been a huge divergence where the dollar is now only a few points away from where it was during the worst times of 2020, and yet financial conditions have not tightened nearly enough to match.
Yes, and we can pull up that that chart from before showing financial conditions. I don't remember off the top of my head what the weight is of the dollar in the financial conditions index, and I should also point out while we're at it that what I did with the Goldman Sachs Financial Conditions Index is reverse engineer it to see how sensitive it is to these different inputs. And so this is not data that comes from Goldman Sachs. It's just my attempt at kind of explaining what needs to happen in each of these indicators to move the needle, if you will. And as we said before, the stock market is by far the biggest. Rates are important. The dollar is important. Credit spreads are important. But the dollar is, like, if the dollar is moving higher and all the other components are staying the same, financial conditions are not going to tighten that much. So when it gets to an acute kind of funding crisis, like we saw during the financial crisis, for instance, or even 2015 when China had a lot of trouble, was devaluing its currency, the dollar was going up, financial conditions tightened a lot, and that was kind of the center of the storm, if you will, because there was just a lack of liquidity in cross-border flows. I don't get the sense that that's happening right now. We saw a little bit of that, of course, in the aftermath of the Ukraine invasion by Russia and sanctions and what happens to dollar funding. But my sense is that right now, this is, the economy is pretty sound. Europe and Japan are both, their currencies. I think the rise in the dollar is more based on the euro and the yen falling than it is necessarily all of a sudden a demand for dollars, if that makes any sense, right? Because in Europe and Japan, monetary policy is loose. It's going to remain loose. The Bank of Japan is already, fighting the very little inflation that they're seeing or the backup in yields that they're seeing by recommitting to buying, unending amounts of JGBs to kind of keep yields repressed. And that, I think, is an interesting model for the U.S. Years from now. I've done work on this looking at demographics, and the U.S. is about 10, 15 years behind Japan in terms of its demographics, so the dependency ratio, labor force growth, et cetera. And so it wouldn't surprise me if the U.S. bond market looks like the Japanese bond market, 5, 10 years from now, meaning very low yields, very low volatility. It's almost not a market at that point. There are days in Japan when there is no trading activity in JGBs. And the long-term JGB has a vol of 3, whereas the long U.S. Treasury has a vol of 11. And that gives you a sense of what a fully repressed bond market can look like. This one is not yet fully repressed. The Fed does own about 30% of the bond market. It owns about 32% of the TIPS market. But the Bank of Japan owns over half of the JGB market, and it buys over half of the flows of JGB. So the U.S. is still behind the Bank of Japan on that front.
I think when you talked about the dollar, you're referencing the monetary policy in Japan would be very loose. There would be yield curve control preventing yields from going up higher. So the dollar and dollar denominated bonds are just more attractive. But I think that this is sort of Japanese yield curve control 2.0, right? Stopping yields from going higher. Isn't the first Japanese yield control, correct me if I'm wrong, was stopping them from going lower because the population was so old and there was a demand for very risk-free paper? Is that when you say the U.S. is going to become like Japan, do you mean we're going to have to enact yield curve control to stop yields from going lower? Or is it sort of the 2.0?
No, it's a 2.0. So,
okay.
So if nominal yields go up too much, and real yields here become positive, which they're not quite yet, you can imagine that in a highly indebted economy, you got that kind of it's a double D's, debt and demographics, right? So you get this toxic combination of kind of slow potential growth and high debt levels. And historically, that's when you see financial repression. That's what we had in the 1940s. I think that's where we will probably be over the next 5 or 10 years. And it would just be a way for the Fed to try to keep nominal yields down. And the Fed, and again, I don't want to sound too cynical here, but so the Fed is not going to deliberately say we want negative yields so that the White House can pay for the debt. Like the Fed's not going to do that. The White House may think that, but the Fed's not going to do that. But they're going to look at financial conditions, economic conditions, and conclude that yields are let's assume the 10-year goes to 4%. They may conclude that that's not conducive to a healthy long-term economy, and so then they might do yield curve control or quantitative easing, but with an emphasis on the long end, which is what the Bank of Japan does, to try to keep yields to some kind of level that they think is sustainable and better for the economy. And that might, I would imagine what they're really saying at that point is what should the real yield be? And they, in that framework, they might say it should be negative to some degree, or at least not positive. Real yields is really the most important, I think, factor to look at. When real yields go up a lot and they are very strongly positive, bad things usually happen because it just cuts off credit from the economy. It makes the real cost of borrowing very, very high, and very sharply negative real yields are also unsustainable because they could create bubble. Financial conditions might become too loose. When you look at historically at expansions in the U.S., and I look at every NBER defined expansion, and I measure how long they are, and then I look at where real yields are in those expansions, and the most sustained expansions, the ones that last the longest, have stable, low, but positive real yields. The ones that have extreme high real yields or extreme negative real yields, those expansions tend to be short-lived. So I would imagine that the Fed might at some point plan around that, maybe not explicitly, but at least implicitly.
And Jurrien, what in the financial system or in the Treasury's bank account or wherever in the economy, what would have be the first thing that breaks that would impel the Fed to enact yield curve control, right? Because something has to go wrong for them to do this.
Since the financial crisis, I look at flows a lot. And from the financial crisis until the pandemic, with yields low and the stock market actually doing extremely well, almost no retail or investor flows went into the stock market, at least as I measure it, via mutual fund flows and ETF flows. Over that 10 plus year period, only about 500 billion or so went into the stock market. And that was about 1.5% of the current market value of the S&P 500. So very little interest in the equity markets. I think presumably because the GFC kind of, people had PTSD from the GFC, sketchy actually, and they were worried about, it was like the Fed and all this stuff. But meanwhile, the bond market saw $3.5 trillion of inflows, which is about 15% of the Barclays Ag. Okay, so there was a very lopsided move into bonds versus stocks. So let's say now that 3.5 trillion of the Barclays Ag went up over that period of time, but you can see right now, of course, with what's happening in the bond market, that even if nobody sold any bonds, your money is going to be worth less, of course, if yields go up. So maybe the dry powder. So what I'm trying to describe is there could be a lot of dry powder waiting to exit the bond market and enter the stock market or other asset classes that are more inflation proof. And so if $2-3 trillion come out of the bond market and go into the stock market, and that's not a prediction, but let's just theoretically say that, that's going to provide a persistent bid for equities. And again, we've seen persistent positive flows over the past few months, even with the Russia invasion of Ukraine, even with all the Fed stuff and the interest rate stuff going on. The flows almost week by week are very healthy, positive flows into the stock market. And again, that could be a tell that investors are like, okay, this is a store of value, that this is going to protect me against inflation. And so, but long story short, if a couple of $1 trillion leave the bond market, that's going to leave a mark, right? That's going to push yields higher. And I don't know I know bond flows are negative right now, but they're not negative enough to tell me that it explains how the 10-year went from 1 to almost 3%. Maybe there's other stuff going on, hedge funds or margin calls, who knows? But in that scenario, maybe the 10-year goes to 4%. It's not my base case, assumption, but you get to a point where the Fed might say, that's too high. That's gonna affect our full employment mandate of the economy. And so that's kind of how I could think about it. It might not even be inflation necessarily staying at 8% or 10%. Maybe it goes to 4%, but maybe investors just say 4 is too high if I'm only getting 3 or 2.5. And then again, if that tide, that long secular tide of all the money or most of the money, investor money going into bonds instead of stocks, if that reverses over the coming years, that's going to be something that we want to be on the right side of.
Very interesting. Jurrien, I want to ask you your outlook about Bitcoin. You've got a really interesting table on the year-to-date performance by asset class, and Bitcoin is a leader, I think, 3 times in a row. Obviously, it comes with a lot of volatility. Do you think that the previous returns of Bitcoin of 80, 130% higher returns per year are sustainable? And do you think the returns will be positive, but lower, but also much less volatile? Or what's your sort of outlook there?
Yeah, it's a great question. And, I kind of went down the Bitcoin rabbit hole about, a year and a half ago or so. Bitcoin is, I think the strength, both the strength and the weakness of Bitcoin is that it is a multidimensional asset class, right? So if we think about gold is a store of value, period. It's nothing more, it's nothing less, and it's kind of a one-trick pony. And if you want a store of value and you're worried about a loss of purchasing power, you own gold, and it's really that simple, right? Bitcoin is a store of value, but it also has an exponentially growing network. So it also has this kind of growthy venture aspect of it, and that combination of supply scarcity, which makes it a store of value, it's a commodity currency, that combined with this, Metcalfe's law, this network effect, I don't know of any other asset class that combines those two things. And so that makes Bitcoin very special, very unique, and very attractive, and I'm on the record many times saying that based on my supply and demand curve, the supply curve is basically Plan B's stock to flow model, but I reverse engineered it because I want to at least understand it. Like if I'm going to talk about it, I need to know what goes in it. But it's essentially that model. And then my demand model, which is based on historical S-curves. So the growth of internet adoption in the 2000s or mobile phone adoption in the 1980s. They all follow, they're all different, but they all follow the same curve, right? So based on where those two supply and demand curves are and where they're going, to me, Bitcoin's, I don't want to call it a target, but to me, I could see Bitcoin being at 100,000 in about the next year or two. So that's a double from here. So that's up and to the right. So I like it. But the problem with this multifaceted, supply-demand characteristic of scarcity and an exponentially growing blockchain network is, to me, that it kind of creates a slightly bipolar, character for Bitcoin, because some days it's treated as a store of value, and other days it's like a meme stock or the NASDAQ, and right now it's perfectly correlated to the stock market. And that, to me, is a major shortcoming, because I think if institutional investors or retail investors are buying Bitcoin, other than, they just expect the price to go up a lot. But if an institutional investor buys Bitcoin, if they buy it purely for price momentum, they can invest in blockchain or in Ethereum and just kind of go on that side of the risk-reward spectrum. If they're buying Bitcoin because they think they're going to lose purchasing power and they want to maintain that, then Bitcoin is very volatile, and I think the reason it's volatile is because with supply scarcity being predetermined, of course. Any delta in the price comes from changes in demand, either up or down. And so when you get a venture-like asset, or an asset that has venture-like components of it, as Bitcoin does, it gets prone to lots of speculation, people chasing it. Everyone talks about Bitcoin at cocktail parties, maybe not as much today as they did a few months ago, but I'm sure a lot of people bought it for the wrong reasons, right? As Michael Saylor once said in an interview, you need to commit at least 100 hours of learning to understand what the hell it is, right? And otherwise, you're not going to understand it, and then you're just a momentum player, and you're going to puke it out as soon as it goes down because you don't have the knowledge to hodl it when it goes against you. So, to me, it's a little bit of a Dr. Jekyll, Mr. Hyde asset class where you never know which side it's playing to, whether if it's store of value, it's going to be more like gold. If it's a momentum asset, more of a growthy asset, then you have to look at the on-chain dynamics and see how many tourists are in versus the hodlers. And I think as we go further into time in the years ahead, that distinction is going to become much more important, because right now the supply curve and the demand curve are saying the same thing. 100,000 2023. Like, it's fairly, to me, it's not basic, it's not easy, but to me that's a pretty solid number, because those curves both point to it. After that point, though, the demand curve becomes more asymptotic, right? It's still growing, but it's growing at a less positive pace as it is now. The supply curve just keeps going, right? The stock to flow curve just goes up in a straight line to, in my view, unsustainable levels. But 5 years from now, one curve is going to be here, one curve is going to be up there, and then it becomes a real relative value play, because if it's closer to the lower curve, the demand curve, and further away from the supply curve, then there's an opportunity that if you think it's a store of value like a digital gold, it becomes attractive, right? And the opposite is, if it's closer to the stock to flow curve and much higher than the demand curve, then it's going to be prone to other movements. So, it's a story, it's a conversation for another time. But what's interesting right now is that gold is, after a couple of years of Bitcoin stealing the show from gold and leaving gold in the dust as a forgotten relic, it's now gold that actually is acting a lot better than Bitcoin. And so it just highlights that gold is a pure play on one thing and one thing only, and Bitcoin kind of does these multiple personalities based on who's in for how long, at what kind of gain or loss. And I think it's a pro for Bitcoin because it has more dimensions, but it's also going to be a limitation for it.
Yeah, you're and I totally agree that you have to study the fundamentals of Bitcoin. I want to take a look at those charts of the supply and demand curves of Bitcoin. They sound very fundamental, very interesting, Jurrien, that nowhere in what you just said in that rigorous analysis did I hear you talk about the Fed's balance sheet. And that is something that the Fed's balance sheet ballooned starting in March 2020. And that's when the huge Bitcoin bull run started, and a lot of people associated with the two. Do you think that they are associated, and is the forthcoming quantitative tightening therefore somewhat bearish for Bitcoin?
Yes, I think it's maybe more nuanced than that. So, like I said earlier, gold is driven by real rates, price inflation, monetary inflation. So when the Fed is expanding its balance sheet like it did 2 years ago until very recently, that is a form of monetary inflation, right? You look at M2, like we were all pulling out the M2 charts in 2020, remember? And we look at something called excess money, so the rate of growth in M2 minus the rate of growth in GDP. And so, of course, the summer of 2020, GDP was cratering and M2 was soaring. And part of that is just a mismatch of time, right? Because the policy response comes first and then the fundamentals follow suit later. But periods of monetary inflation have been very good for gold, and I use that same logic to say that it should be good for Bitcoin as well. And so if the Fed is doing quantitative tightening, depending on how much it's doing, and it's raising rates, as it is doing right now, on the surface, that should be a negative for gold as well, for gold and Bitcoin, because liquidity is leaving the system. Real rates are reverting back to something more normal, and it lessens the need to have a store of value, because if real rates go back positive, which they're not yet, but let's say for the sake of argument that they would, then it just becomes less of a of a pressing issue to be in an asset class that preserves your purchasing power. And then and at that point, the allure for gold goes out the window because you just don't need it anymore. And then at least Bitcoin has this other feature to stand on, which is this exponentially growing network and the whole blockchain thing and a payment system potentially. So it's a plus for Bitcoin, but it's again, like I said, it's a question of what is driving the price now, right? I mean, if too many people who are not hodlers bought at 60 and then it goes to 40, those people are going to sell because they're not hodlers. They didn't do the work. They don't they don't have the conviction to hold on because they didn't, they put in 1 hour instead of 100 hours. And so that's where you get this boom bust dynamic like we see in the meme stocks. And I don't think any of us who are bullish on Bitcoin, as conceptually and in terms of asset allocation, want to see our beloved Bitcoin be succumbed to those kinds of waves like the Nasdaq does. But it happens, right? It's a new asset or relatively new asset. Gold had the same thing in the 70s. It had massive booms and busts on the way to far, far higher prices. So it kind of comes with the territory. Think of it as the internet, revolution in the 90s. There were a lot of winners and losers, and even the winners lost a lot before they won again, right? So it's the price we have to pay. But I think over the long term, like we talked about earlier, if financial repression is going to be part of the story for many years to come, like it is in Japan and like it was in the US in the 1940s, then real rates will probably be lower than they historically have been, and they might even be negative. And in that scenario, even if they don't become sharply negative, like they don't have to go to -10, but if the consensus becomes that it's going to be negative for a long time to come, it could drive some significant strategic asset reallocations, out of fixed income into real assets. And I think Bitcoin will be part of that mix, as will gold, as will equities, as will real estate, as will commodities. And so we just have to survive the ups and downs until we get there.
Fascinating. Jurrien, it's been so great having you on Forward Guidance. Thanks so much for sharing your insights and your time. People watching this, they can follow your work on @Timmer Fidelity, and you post so many of the great charts on Twitter, but you post them in sort of bite-sized pieces for people to digest because they're quite in the weeds. But Jurrien, if people want access to an entire sort of deck or a report that I got to see, can they get that, or do they have to be clients of Fidelity? Like, how can they sort of get the full experience?
For the full reports, and I write a fairly long report every Sunday, but it's an internal report. But versions of that get published externally as well. Those will be available on fidelity.com via our viewpoints area, and as well as for institutional investors. So,
wonderful. Well, Jurrien, thank you so much.
Great. Thanks, Jack. Appreciate it.